We look forward to seeing you again on our channel as we explore the interesting field of history, recessions. The most gloomy times in American economic history are the topic of today's discussion. Join us as we examine the origins, effects, and how they impacted American history as we examine the worst recessions to hit the country in the past. Let's get going. The Great Depression. We embark on our journey through the most notorious surge of recessions in U.S. history with the infamous one, the Great Depression. This period, enduring from 1929 to 1939, marked a devastating economic slump that had far-reaching consequences for the entire nation. The Great Depression was initiated by the stock market collapse of 1929, also referred to as Black Tuesday. Excessive speculation in the stock market, together with inflated stock prices and easy credit, forged a bubble that eventually burst, leading to a rapid decline in stock values. However, the crash itself was merely the catalyst that sparked a sequence of underlying economic predicaments. One significant element contributing to the severity of the Great Depression was the uneven distribution of wealth. During the 1920s, the affluent elite controlled a substantial portion of the nation's wealth, while the average American struggled to make ends meet. This income inequality resulted in reduced consumer spending and weakened aggregate demand. Another pivotal aspect was the decrease in international trade. The imposition of high tariffs, such as the Smoot-Hawley Tariff Act, instigated a global trade war, limiting foreign markets for American goods and worsening the economic downturn. The impacts of the Great Depression were widespread and devastating. Unemployment rates skyrocketed to unprecedented levels, reaching almost 25% at their zenith. Many businesses, unable to sustain themselves during the economic downturn, shattered their doors, leaving countless workers unemployed. Families faced extreme poverty, with homelessness and hunger becoming widespread. The collapse of the banking system further intensified the crisis. Banks failed, eradicating the savings of many individuals and causing a loss of faith in the financial system. The scarcity of available credit severely impeded economic recovery and hindered investment in productive ventures. The psychological impact on the American people was immense. Confidence in the future was shattered, and a sense of despair and hopelessness pervaded society. Many people lost their life savings and were compelled to rely on government relief programs such as soup kitchens and bread lines to survive. In response to the Great Depression, the government implemented various policies to alleviate the crisis. President Franklin D. Roosevelt's New Deal introduced a series of programs and reforms aimed at stimulating the economy and providing relief to those most affected. This encompassed the creation of jobs through public work projects, the establishment of Social Security, and the regulation of the financial sector to prevent future economic crises. Moving forward to the 1970s, we encounter another notable period of recession known as the oil crisis. This economic downturn, combined with a distinct phenomenon called stagflation, presented a challenging economic landscape for the United States. The oil crisis of 1973 was triggered by a series of geopolitical events. The Organization of Arab Petroleum Exporting Countries declared an oil embargo, leading to a sharp surge in oil prices and a disruption in the global oil supply. This was in response to Western countries' support for Israel during the Yom Kippur War. Consequently, the cost of energy surged, resulting in a significant economic jolt. The sudden increase in oil prices had wide-ranging consequences for the U.S. economy. Energy-intensive industries, such as manufacturing and transportation, faced heightened costs, leading to reduced production and job losses. Moreover, consumers had to grapple with higher fuel prices and increased expenditures on goods and services. The oil crisis coincided with a unique economic phenomenon known as stagflation, a combination of stagnation in economic growth and high inflation. Traditionally, these two factors were believed to be mutually exclusive, as inflation was often associated with periods of robust economic growth. However, during this period, the U.S. experienced sluggish economic growth alongside surging inflation rates. Stagflation posed a significant challenge for policymakers. Traditional monetary and fiscal policies aimed at stimulating economic growth proved ineffective in combating inflation. The government faced the dilemma of choosing between controlling inflation or promoting economic expansion. To address stagflation, President Richard Nixon implemented wage and price controls in an effort to restrain inflationary pressures. However, these measures proved to be only temporary remedies and did not effectively resolve the underlying issues. The impacts of the oil crisis and stagflation were felt throughout the nation. High energy prices led to a decline in consumer spending and reduced business investments. The manufacturing sector suffered significant setbacks, resulting in layoffs and factory closures. Inflation eroded the purchasing power of households, leading to a decrease in living standards. The government, under President Jimmy Carter, responded to the recession by implementing energy conservation measures and promoting alternative energy sources. The Strategic Petroleum Reserve was established to mitigate the impact of future oil disruptions, and initiatives for energy efficiency were introduced. As we approach the turn of the millennium, we come across the burst of the Dotcom Bubble, which resulted in one of the most significant recessions of recent times. The Dotcom Bubble refers to the speculative frenzy surrounding internet-based companies during the late 1990s and early 2000s. The Dotcom Bubble was fueled by the rapid rise of internet-related technologies and the promise of limitless potential for online businesses. Investors poured massive amounts of capital into internet startups, often without considering their profitability or sustainability. Stock prices of these companies soared to astronomical levels, driven by speculation rather than sound financial fundamentals. However, the bubble eventually burst in the early 2000s, leading to a sharp decline in the stock market and a subsequent recession. Many internet companies, especially those that relied heavily on advertising and e-commerce, faced a reality check as their business models proved to be unsustainable. The bursting of the dot-com bubble had a significant impact on the economy. Many internet startups went bankrupt or suffered significant losses, resulting in massive job cuts and investor losses. The stock market experienced a substantial decline, wiping out trillions of dollars in market value. The fallout from the dot-com bubble burst extended beyond the tech sector. The ripple effects were felt throughout the economy as consumer spending decreased and businesses faced declining revenues. Investor confidence took a hit, leading to a cautious approach in financial markets. In response to the recession, the Federal Reserve implemented monetary policy measures such as lowering interest rates to stimulate economic growth. The government also enacted legislation such as the Sarbanes-Oxley Act to increase transparency and accountability in corporate reporting. The dot-com bubble burst had a long-lasting effect on the technology industry and investor sentiment. It brought about a more cautious approach to investing in emerging technologies and led to a greater focus on profitability and sustainability in business models. However, it also paved the way for the next wave of technological innovation as lessons learned from the bubble helped shape the future of the digital economy. Our journey through the history of recessions brings us to the 2007 to 2009 financial crisis and subsequent Great Recession. This recession, originating in the US, had a profound impact on the global economy. The financial crisis of 2007-09 was triggered by the collapse of the subprime mortgage market in the United States. Banks and financial institutions had engaged in risky lending practices, offering mortgages to borrowers with poor creditworthiness. These subprime mortgages were then packaged into complex financial instruments and sold to investors, spreading the risk throughout the financial system. As the housing bubble burst and home prices declined, many borrowers defaulted on their mortgage payments. This led to significant losses for financial institutions, particularly those heavily invested in mortgage-backed securities. The interconnectedness of the global financial system meant that the shockwaves from these losses reverberated throughout the world. The impacts of the financial crisis were far-reaching. The banking sector faced a severe liquidity crisis, with several major financial institutions on the verge of collapse. The credit markets froze, making it difficult for businesses and consumers to obtain loans, which in turn hampered economic activity. The housing market suffered a significant downturn, with foreclosures skyrocketing and property values plummeting. Many homeowners found themselves underwater, owing more on their mortgages than their homes were worth. This further exacerbated the financial strain on individuals and families. The Great Recession that followed the financial crisis was characterized by a significant contraction in economic activity. Unemployment rates surged, reaching double-digit figures in some regions. Businesses struggled to survive, leading to widespread layoffs and downsizing. In response to the financial crisis, the US government implemented several measures to stabilize the economy. The Troubled Asset Relief Program was enacted to provide financial support to struggling banks and prevent a complete collapse of the financial system. The Federal Reserve also implemented monetary policy measures, such as lowering interest rates and conducting quantitative easing to stimulate economic growth and improve liquidity. The effects of the financial crisis and Great Recession were felt globally. Many countries experienced economic downturns and faced challenges in their financial systems. Governments around the world implemented various stimulus packages and regulatory reforms to mitigate the impact and prevent future crises. The financial crisis and Great Recession had a lasting impact on the economy and society. It highlighted the dangers of lax financial regulations, risky lending practices, and the need for improved oversight of the banking sector. The crisis also led to significant changes in financial regulations, such as the Dodd-Frank Act, aimed at preventing a similar crisis in the future. While the economy eventually recovered from the Great Recession, its effects are still felt by many individuals and communities. The scars left by this recession serves as a reminder of the importance of prudent financial management, regulatory vigilance, and responsible lending practices in maintaining a stable and resilient economy. As we conclude our exploration of the world's recessions in the US history, we reflect on the long-lasting impacts they had on economy, society, and on policy making. Each recession presented its unique challenges, but they all shaped the nation's economic trajectory and influenced the decisions made by subsequent generations. Join us next time as we continue to uncover fascinating stories from the annals of history. Thank you for watching. If you enjoyed this video, make sure to hit the like button and subscribe to our channel for more captivating content. Let us know in the comments below which recession you found most intriguing. Don't forget to share this video with your fellow history enthusiasts. Until next time, stay curious and keep exploring.